background to it is, I know Bidco has an array of products that are straddled in various corners of our houses, right from the kitchen to all the rooms in the house. And I was joking with colleagues that that can be a barometer, really, of how the economy is reflective based on the consumption of the various lines of consumptions, and which you have more color than myself. But my query will be, we've been, you may, and your business also has cross-border touch points across the various 17 markets that you serve. So that said, in an envelope, and from where we have been in a very volatile environment, what are you also seeing from business side now? Stella has given us a view from the bank view, but from the business lens as well. What are the opportunities that you see? The macros aligned? Are we back to, is the ship stable? Are we flying the way we should? Maybe you can give us a broad question, but what will be your perspective on this?
Thank you. Thank you, George, and good morning, everyone. I think if you look at a macro lens, statisticians always say the statistics are looking good. We're at 4%, 4.6% growth, 5% averaging as a GDP growth. Looks good. So I think on paper, that looks very good. The question is, how is the public feeling it? How is the Mwananchi, or as we call them, Wanjiku in Kenya, feeling it? And what are they doing about it? And I think the key issue is that it's a tough environment. There is no doubt about being a tough environment. I think the government's gone into this mode of saying we got too much debt on our books and therefore just collect it from Kenyans. And therefore they've hit the payroll. And I think once they hit your pay pockets, right, they're actually hitting that, and it's gone to about 15 to 18% overall with this different levies all across, and that cost us. At the same time, we haven't increased our salaries by 20%. Had we done that as a country, I think this would have been levelized. So I think earlier I heard it being said that tax is not a bad idea at all. Tax is not a bad idea, but then you've got to be able to afford it. The affordability issue, and I think you talked about it, disposable income going down and contracting by 18%. I think the issue that comes in is people have gone through more and more essential products. Number two, luxuries are all sort of being delayed or postponed. Secondly is, even in essentials, I think the total pace of consumption has come down by about 10%. So essential, you're probably consuming less or whatever. And that's countrywide. The reason? The disposable income. I think if we had a radical improvement on that, there could be a system whereby all salaries are raised by a certain amount. Of course, no more levies to be raised. But at the same time, I think the important thing would be that demand keeps on. As a population, we've got a population that's increasing. So when you look at food, clothing, and shelter, basic needs will still be there. The question is our employment increasing? Are people getting more and more employment? And that's a big issue, because right now, that's going down. Reason? A lot of startups, a lot of companies that are really starting off and all that stuff are not surviving, are not being able to meet their 1 year, 2 year, 3 year goals because they're just shutting down. And this probably, excuse my language, is probably because of the bankers, not this Absa Bank, but bankers who raise their rates to 18, 20, 22%, and people are borrowing at excessive rates, and they're doing a startup. Now, along with the startup, you're getting rates of borrowing at a very high level, if at all you get borrowing. Secondly is also the issue around the taxes on startups. So if you look at many more startups, they have to pay about 100, 200,000 shillings in licenses and fees, which are non-value adding. So when you look at the environment, I think that's a key issue. So if you talked about, your question was specifically, has consumption gone up or down? Consumption has gone down by about 10, 15%, but on essentials, it's gone down by 10%. On non-essentials, I think luxury products, maybe people are postponing. I can make my shirt last another year and it's okay, right? Or I was talking to somebody about the paints. I cannot paint right now and say I'll paint it next year or year after. We'll postpone capex. Number two is new investment in a lot of places. People have stopped doing new investments here because we're not as attractive as we were before, right? And that's a big issue. And I think, again, access to capital, access to credit. Stella talked about it. We don't have any new access to capital if you're starting a new project in this country. Why? Because the lenses that the bankers are wearing and I'm sure there's too many bankers here, are all about risk. The risk is too high. It is too risky to lend to anybody for any project, whether small company, big company, or medium company. And therefore, the whole perspective has changed to say, hey, you know, this is a risky area. Let's not go into it. At the same time, the double whammy is that we got a lot of, I think, a lot of importers here, right? Imported products are becoming more and more competitive. So it is easier right now to bring product from Egypt and really put it into the consumer market because there is no duty on it. Whereas here we've got a lot of duties and taxes on everything, including employment taxes, including excise duties. All these add up to make us uncompetitive. And I use the word uncompetitive. Competitiveness of Kenyan industry and Kenyan manufactured products has been eroded. And that's a country policy. However, all is not lost. To be open about it, the government is now listening and saying, let's do something about it. So they want to have dialogue and discussions. The intent is good, so I just don't want to be negative about this. The intent is good. The government's pronouncing itself in terms of we want to do this, we want to have a 10% GDP growth, we want to have 20% of manufacturing as a percentage of GDP by 2030. The intents are good. The actions are not. And this is the biggest problem. What they say, you know, in Swahili we say, kusema na kutenda ni tofauti. So what happens is, what they're saying and what they're doing are two different things. And that's having the opposite effect. So overall, I don't know, I know we're not going into solutions, but as a solution, it would be like, let's do austerity measures. Let's make sure, like you said earlier, the spending is not done in the wrong areas. It's done in the right places. And therefore, now with the new interest rate reduction, which also I think was drastic, I hope it doesn't lead to capital flight. But the point is, if that's available and made available to a lot more people, they could do more trading. But today, as we speak, competitiveness of local manufacturing has been eroded, and that's some drastic action required there. Importers, I'm sure you're all laughing and saying, let's go and import more and you know, survive in the market. But at the same time, I think it's got to do with the administration and the regulation. So we probably need to deregulate. We probably need a Trump type of activity here, which says DOGE in Kenya and remove all government excesses and all that stuff on a fast-track basis. So maybe we bring in, you know, Elon Musk here. Thank you.
Thank you, Dr. Vimal. And who knows, you might just be part of the team that will do that. Great. So, allow me to just bring him back on one aspect, because you said we are not really solutioning, but allow me to request you to solution, because we are speaking to importers here. And Bitcoin as a franchise really has quite a number of touch points in the global economy. We are all in a global trough. It's like when you drop a stone in one end, it affects the waves capture or hit everyone across like a tsunami. So I know the landscape has changed. The last year to this year, landscape has considerably changed. Is there one thing that maybe you think we could still be checking around from a global economy perspective? Are there risks that you see? Are there opportunities? Speaking to importers here who also have their manufacturers outside there. You've mentioned Egypt. I know a good number in China, a good number straddled across the world. What opportunities or risks do you see?
So I think the government's trying to solution this in a manner where let's put more taxes on imported products, okay? So China, India, all these traditional markets, they probably have that tariff thing. I think Trump's doing the same thing, so it's not a new thing. However, I think the key issue would be that when we look at our country and we look at solutions here, I strongly feel that it's got to be time to become lean. Everyone needs to become lean. I don't think just giving open credit, I know you guys love credit and you give banks give a lot of money, but as a trader, as an importer, as a trader in Kenya, do not give excessive credit, number one. Number two, try and control your number of days very, very fast, because you can give less product. A lot of people do over trading in Kenya, and that's why they say, oh, somebody's asked for 10 more, 10 or 20 more, they say, I'll dump you with 100. And therefore you end up in this syndrome of bad debts or not being paid. And those goods just lie there. Working capital needs to flow. So I think just in time, and I would advise everybody to look at just in time and say, fine, whatever you give them, make sure the credit number of days is reduced and you keep on delivering more and more. In fact, more often deliveries, a daily delivery might be a good idea rather than have a weekly delivery. And therefore you get your cash flow cycle faster. even easy credit or at expensive costs is not going to really get you a lot more trade. And I think that's important, number one. Number two, the credit worthiness of the person you're dealing with. So important in this country today because a lot of people are just packing up and you don't know what's happening to them. So that's something to be watchful of. KYC. I think the KYC systems you need to put in place to say, fine, are people legitimate or not? Lastly, I think in terms of margins, the margins have been thinning out. And a lot of people are trading at very, very thin margins. Now, if on top of that, there comes a levy or a tax or an extra payment or a KRA issue, I think that's a big issue. So I think make sure that your records, and all your records are really intact. We've got a whole withholding VAT and tax and VAT refunds. That syndrome is still stuck, although the government's done a good job. But I can tell you one thing, we were surprised last year. We were very much surprised that it came from 160 down to 129, right? It caught us unawares. We probably had even hedged and we lost out on the hedges. Like Vuyo was saying, it wasn't lost out, but it was more of, okay, we had paid insurance for it. But the point is, against all odds, this economy has been doing, in terms of currency, FX rate, has been doing wonders. For this year, we don't expect a rise again because the government's controlling it quite well. So 129, 130 average. So I'm sure your hedges are not going to be placed. But again, it's your own risk. Take your own risks. The other thing is our currency vis-a-vis exports and exporters. We're also in the flower trade. We export flowers every day to Holland. And I think there we suffer because we get a lower amount of Kenya shillings for that. But at the end of the day, we've also got costs in foreign currency, and therefore that balances out. However, I think the important thing is keep your head above water, find out what's happening, because things could go uphill and downhill. And you could have a lot of turbulence pretty soon if this USAID thing comes up in a big way, or if we are sanctioned as a country. I don't believe Kenya will be sanctioned by the US, but if we are sanctioned, we've got to get ourselves up and running quickly. So I'm just saying those are, like they said, likely risks, but we don't factor them in. But those could happen now. I'm not saying it's going to happen because I don't think Kenya is doing anything odd or negative about it. But these are risks that could come in, and they could come in faster, or they come in to teach somebody a lesson. So I'm just saying these are volatile risks. So it is volatile times. I would say don't overtrade, don't go beyond your means, and rather than debt, try and look for equity or try and look for smart partnerships. I don't know if APSA does, equity raising or people for people, but that's something that's look at that in a different way, and probably get more equity into your business, reduce your debt levels. We as a company did that last year. We went completely debt-free, and today we're expanding. So we're on the spur of buying companies right now. But I'm just saying, for you, do not overtrade, do not overstock somebody with so much product that they don't pay you, and then you're stuck in that syndrome, including if you're dealing with government. I hope there's nobody in government here.
No,
be very careful. Yeah. You may not receive your payments, so somehow work it out that is factored in by a bank or somebody, and they take the risk. Otherwise, dealing with government today, your bills may not be paid.
Thank you, Dr. Ari. You've got the nuggets of wisdom, right? You know who to deal with. So let me tie up your conversations and ask Dr. Mark this. Last year, as Dr. Vimal has mentioned, about the significant volatility in the FX space and also in the interest rate space, we'd seen there are levels at which banks were lending, and it's not confined to APSA. It's just where the cost of capital was. How has this revert impacted your business? Because that really also translates to the members here, the clients here in this room. How has the revert from the 160 levels to now the 129 levels, the borrowing levels from maybe it's north of 20 to slightly lower? Steve will unpack where he's extending credit at. How has that affected your business? And I hope positively. Yeah, thanks.
Yeah, George, thank you very much. Again, good morning. Is it afternoon? Good afternoon. It's a morning, eh? Oh, yeah, sorry, good morning. So just to unpack your question, with regards to, there's a lot Dr. Vimal Shah said, and I almost thought he was speaking to me directly, because it affects me directly in many ways, but I think just to first unpack the issue of exchange rates from 160 down to 129, being really net importers that has had a benefit to us directly. Because for most of the items we trade in, which is medical equipment, most of them at that point were buying at very, very high exchange rates, importing from India, China, Germany, America. So that has, in our case, the reduction in interest rates has helped free up some cash flow in that case, I should say. Two, we've also suffered the negative impact because we also export to countries like South Sudan. So where we were earning in USD and then getting a better conversion rate in Kenya. So now when the dollar came down to one, or the Kenyan shilling came down to 129, then we started to realize less gains on our end. But I really want to just reiterate something Dr. Vimal Shah said, because I think this issue of overtrading is, I think, part of the biggest problems that most SMEs and MSMEs are facing today. Because again, you're importing on a credit cycle, you're then supplying government, in this case, as he mentions, and it goes 90 days, 120 days, then that has real impacts on your business. But yeah, just in a nutshell, so I think the reduction in interest rates have, one, helped us because, of course, our borrowing costs have come down, but also on the FX side, it's also helped to have more predictable import costs in a nutshell. Yeah, thank you.
Thank you, Dr. Mark. And I'm sure bankers here, Dr. Vimal, they have quite some cash to offload. So really inviting you to talk to your relationship managers, your corporate directors, happy to extend and curate solutions for you, even as the business landscape changes. So let me turn back to Churchill and ask, Dr. Vimal has mentioned about the 129 mark, which has sort of become the reference point for the USD versus KES. So is the government-to-government oil deal the magic wand in all this? One. And really, when you look at all that the government has been, credit to them, they've done some great footwork with respect to refinancing of the infrastructure, the debt structures, they're extending debt out. So is that what is the silver lining we should look at? Because it can't all be risks, there are also opportunities in this local economy. So what is the silver lining that you're looking at? With respect to one, you can touch on the G2G and then also the silver lining based on the kind of economic or footwork the government has been doing lately.
Yeah. Thanks, George. So on the government-to-government oil import deal, so this came around March 2023, and initially it was supposed to be for 9 months. There are 3 products that had been categorized to be imported through the government-to-government deal, super petrol, diesel, and kerosene. And it was further extended to December last year. And then last year, mid-December, we saw the cabinet brief, including other products. So this is the bitumen, liquid petroleum gas, and also fuel oil. So we have 6 products currently under G2G, and we don't have a sunset date as to when it will come to an end. Basically, looking at the cabinet brief that came last year. So that speaks to, and the effect of G2G, initially we could see the oil marketing companies coming to banks, sourcing dollars so that they could now be able to import the oil. But now the G2G oil credit credit plan that came into place now gave them 6 months, and then they are importing oil, but now 3 oil market companies importing oil on behalf of the industry, and the industry paying in Kenyan shillings, and then the payment will be done after 6 months. So that has led to some stability. And remember, the G2G came right about the same time that FX interbank market was restored. So banks being able to transact among themselves comfortably. And I think those 2 measures has led to stability in the shilling. That said, from 160 to 129 was quite a big shock, to be honest. Officially, what is coming out is that what happened in February last year, the buyback of the $2 billion, they bought back roughly $1.5 billion, and also the infrastructure bond that was issued in February last year as the proximate cause of that sharp adjustment. In divergence to it, but anyway, this is not the official reason towards that. But if you look at the stability after that, 129 speaks to the period between 2015 to 2019, whereby on average our shilling will depreciate around 1% in any given year, amidst all the shocks that is happening, and also comparing to other, I normally cover a number of African countries, and if you sort of compare other peer countries on the continent, 2015 to 2019 period was somewhat like an outlier. So that is what is playing out right now. So what evidently is driving the shilling to this stability, we've seen the central G2G playing a part. And from an analyst perspective, you look at it, there's what we call the net foreign assets. So from a banking perspective, your foreign assets liabilities were more than the foreign liabilities were more than the foreign assets to the tune of $2.3 billion. This is as of September 2022. It peaked, it reverted, and then it went to a net foreign asset liability. So the foreign assets were more than the foreign liabilities by around 3.3 billion. So that was as of July last year. So that has now led to, because banks are sitting in excess FX cash, so what you've seen CBK coming in to buy dollars in the market, and there's a bit of a lack of transparency, the quantum that they've been buying, but this now speaks to the stability that we're seeing. So obviously, as somebody who sits in the asset management, and we are paid to think about the risks out there, and also speaks to some of the solutions that we had earlier on in the presentation, what will happen if CBK is not coming in to buy dollars to sustain the shilling? So probably this speaks to some of the solutions that we had, but obviously we could see a repeat of some further depreciation. So at the back of our minds, we don't expect a massive, but just to keep at the back of our mind that a repeat of the reversal happens, what will happen to our businesses? So that's one. The second one is on the fiscal, just tying to what you've seen happening by the government. So we have this liability management operations that have been conducted. So basically, from the domestic side, we had maturities, some heavy maturities coming up in the months of April and May